this number, were you expecting it to be so strong?
Look, it is a little stronger than we were expecting, but the themes that did come through were pretty well expected. So, for example, a lot of that disinflation you were talking about in annual inflation, so that has come lower on an annual basis. That's been due to tradables deflation. So tradables are things like food and clothing and footwear and household goods. And we've seen prices actually fall in some of those categories. But what's quite concerning is that services inflation has actually accelerated on a quarterly basis, and non-tradables inflation is still running too high as well. And they will certainly be in focus for the RBA. They're reflecting things like still that tightness in the labour market, stronger wages, but also that tightness in the housing market that you referred to.
Yeah, and I'm looking at the data on the screen, and when you look at the trimmed or weighted means, the measures that strip out the volatile items, they all came out a little higher than the market consensus forecast as well. Is this data going to worry the RBA?
Look, it is a little stronger than what the RBA had penciled in. So we think that they had 0.8s in for the quarters for both headline and trimmed mean, and it came out at 1 for both. So we think they will be a little cautious about interpreting some of this data. But we've been saying for a while that we don't see the RBA looking to cut rates until November. You'd need to see weaker non-tradables inflation, weaker services inflation for the RBA to be convinced that overall inflation is not only going to return to that 2 to 3% target band, but actually stay there as well. So by that November meeting, we'll have the Q2 and Q3 CPI data. But the risk is that if some of these domestically driven price pressures don't start to ease by Q2, the risk is that those rate cuts do get pushed out into next year.
And when we're talking about those services inflation measures, the health, education and housing, I suppose, could be falling into that category as well, given rents are such a large component. I mean, what are encompassed in those cost measures? What are people feeling in terms of the price rises out there?
Yeah, I mean, it's certainly, particularly for a lot of the essentials, we're still seeing quite a lot of price rises. So rent certainly still going up very quickly, and that's unlikely to change anytime soon, given that rental vacancy rates are so low. And I'm sure anyone out there who's looking for a place to rent is finding it quite difficult at the moment, unfortunately. But things like the health side and the education side, I think it's still reflecting some of this stronger inflation that we've seen over the past few years. And we know that education, for example, prices are only generally adjusted sort of once per year at the start of the school year as well. So they were very strong too. But looking more broadly across the services, that tighter labour market and the stronger wages growth, while it meant that inflation earlier on was a bit lower than it would have been otherwise, because wage growth in Australia took longer to pick up, because we're now seeing wage growth peak, that is going to slow that decline in inflation now.
So with this data in mind, and given you've only had about 7 minutes to look at it, do you think it's going to change your outlook when it comes to rate cuts in November? I believe that's your forecast.
Yes, our forecast is still November, and we've had that forecast for quite a long time. I think the data today, given that it was a bit stronger than the RBA had penciled in, particularly on that non-tradables and services side, probably means that the risks have tilted a bit towards a later start to rate cuts. But we'll review that when we look through the details as well.
Of course. And I'm just looking at the market rate probabilities that are sort of bouncing around as we talk. Just a couple of minutes ago, there was even a forecast of a 1.6% chance of a rate hike in May. That's now disappeared from the screen. But certainly there is obviously a lot of movement in the market as traders digest these numbers. I mean, do you think there's any chance we could see a rate hike in Australia, or is the RBA very much headed toward cutting rates when it next moves?
Well, look, markets can be very volatile, but they certainly responded to what we saw, I think it was last week or the week before, that much stronger than expected US CPI. So markets are now trying to interpret whether the signal from the US is relevant for other countries, including Australia as well, with that potential scenario of inflation actually remaining higher for longer and not actually returning to target on a sustainable basis. Look, we still think that the next move from the RBA will be a cut rather than a hike. We know that the current cash rate is in restrictive territory. But we also think that activity will start to improve this year as well. Inflation is now below wage growth, so household purchasing power is improving. We've got tax cuts coming through from the 1st of July, which will also boost household disposable income. And business investment and government spending is still looking reasonably solid. So you can't write off the possibility of the next move being a hike rather than a cut, but we think it is a pretty low possibility at this stage.
And of course, that's sort of the neutral territory the RBA is walking on at the moment. Just finally, Catherine Birch, what will the RBA be looking for next? What's the next flashpoint in terms of data?
Look, there's essentially three categories the RBA is really focusing on at the moment. So that inflation data, the labour market is incredibly important as well. And we saw last week that the unemployment rate ticked up a bit, but it is still very low at 3.8%. But the other category they're really looking at is that activity. So how households are doing, how household spending is showing up. And that has been very weak. So they do have to balance this inflation data and the reasonably solid labour market with that weakness in household activity as well. So, GDP will be an important indicator coming up, but it is quite lagged as well. So it doesn't give us a very up-to-date read on what's going on.